Hi everyone, welcome to today's live video. My name is May Doldelau. Thanks so much for being a friend and a follower. If you're not already subscribed to the YouTube channel, go ahead and click on the right side, subscribe to the channel, and thank you for being a fan on Facebook. So today we're going to talk about 3 examples of how to rebalance an all seasons portfolio. Okay, so my blog is yesfinanciallyfree.com. For more great information to get on the email list, go there, put in your first name, email address on the right side. If you're on the phone, scroll down, put in your first name, email address, and then click the big red yes button, and you'll get on the email list. You get a free Working Parents Guide to Financial Freedom sent instantly to your inbox. Okay, so that is an important step. So just do that, and you'll get emails about all the lives I do, what I talk about in detail and written out before I do it, so that you can jump on and catch me live. So a little bit about myself. I live in Waikiki with my son, Jordan. He's 6 years old, and my husband, Jamel. We own this condo. We own another one down the street in Waikiki, which is an Airbnb business. Now, back in 2011, I had over $40,000 of debt, and I didn't own any property. I was not good with money. Okay, guys. I worked at a bank. I was an assistant, and I made like maybe $35,000, $36,000 a year, something like that. And that was it, before taxes are taken out. But I had over $40,000 of debt. It was like 8 different credit cards, lines of credit. All right. So by April of 2016, paid all that debt off. But not only that, improved our family's net worth by $500,000. And we were paying ourselves almost $500 a month in passive income. So I quit my job. My last day was December 23rd. And 2016, I became a full-time mother and part-time finance freedom coach. Continued doing yesfinanciallyfree.com, but I started mastermind programs, which I called Finance Freedom Masterminds. I created a business, and basically clients just come to me on Zoom since 2016, and we meet online, and we just do what I did to pay off debt, but also create passive income while increasing net worth at the same time. So there's skills, there's procedures to follow certain steps that I learned from various mentors over the years. And so I made a training program that goes on for a whole year, where we have 40-minute sessions a week. But it's really good because every week you meet with a group, you do a little training, you do the right steps, you have a monthly coaching session to do your numbers, your net worth, your passive income, everything. And you do it for a whole year. So you change your money habits, you change your life. It's really exciting, and I really love it. I think it's effective because sometimes seminars hype you up, but the long run, you need to change your actions to change your results, right? Okay, so today's topic, and I shared that story with you just to let you know that if you're not good with money, you can turn your life around and become great with money. Today's topic is 3 examples of how to rebalance an all seasons portfolio. So it's a little more in depth than one of my typical topics, because I'm going to be talking about something if you want to invest by yourself without an advisor. And this is recommended by Burton Malkiel. He's a professor who wrote Random Walk Down Wall Street and some other book that I reviewed on my blog. I can't remember the name, like 10 Rules of Investing Success or something like that. But anyway, he's a very well-educated man. His research helped develop index funds, which everyone uses nowadays. And he says you should just do your own investing, do your own portfolio. You don't need to hire anyone. The one thing that destroys portfolio results the most, your investment, that ruins your investments, is that you pay part of it to an investment advisor, and that takes at least 1% off, maybe more, off your investment returns. So if you just do it yourself, you can make a lot more money. And so today I'm talking about 3 examples of how to do it yourself. So I'm using the all seasons portfolio. What is the all seasons portfolio? Now, my blog has information on this, and so you can go check it out. But I'm going to write down what the all seasons portfolio is, so you can kind of get an idea. Let me write it out for you. So basically, you take your money and you divide it among 5 different types of securities. Okay. And I'm writing them down. But the first is gold. 7.5% gold. And then 7.5% commodities. 15% intermediate term U.S. Treasuries. 30% stocks. And 40% long-term U.S. Treasuries. Okay? And when he says intermediate term, he means 7 to 10 year. And when he says long term, he means 20 to 25 year, just so you kind of get an idea. Okay. So this is what an all seasons portfolio looks like. Okay. 7.5% gold, 7.5% commodities, 15% intermediate U.S. Treasuries, 30% stocks, 40% long-term U.S. Treasuries. Okay. So let's say you took your money and put it there. All right. So let's say you had $1,000 and you put it in here. So you would have, if it's $1,000, then you would have $75 in gold, $75 in commodities, $150 in intermediate U.S. Treasuries, $300 in stocks, and $400 in U.S. long-term U.S. Treasuries. Okay. Now, Ray Dalio recommended this for the average investor as the best kind of portfolio to invest your money in. And you do it with index funds. Okay. Now, gold isn't an index fund. It's just a fund that mimics gold. Then there's commodities. They're not index funds either. Commodities are a little more complicated, but they're funds. Okay. And then intermediate U.S. Treasuries, they have funds. Okay. And then stocks are index funds long term. So you can do exchange traded funds or mutual funds. So that's the deal. Now today's not about how to build it, it's how to rebalance it. So I'm assuming you already know how to build it. Maybe I need to do another training on how to build. But basically that's what you do. You find the funds, you buy them in this percentage, and then you have it. Now, let's say over time, everything changes because everything's always changing. Stocks go up, stocks go down. Long-term treasuries as well have some fluctuation. Gold, commodities, they go up and down in price, right? Depending on what commodity you have invested in, they're not all going to look the same. So you're going to have a lot of fluctuation. So just because you start out with, $75 worth of gold and $75 worth of commodities and so on, maybe after 1 year, your gold is worth $100, your commodities are worth $30, everything fluctuates. Maybe your stocks are worth $200 because maybe there's another meltdown in a year, and maybe your long-term treasuries are worth $500, and your intermediates are worth $200, whatever. I don't know what they will be worth, but I'm just saying that they will definitely be worth a different amount than when you initially invested, because that's the nature of markets. They go up, they go down, they don't stay the same. Okay. So in a year, in order for the portfolio to work, okay, you need to rebalance. What does that mean? It means make all of them back to the original percentages. So if you have more than 7.5% in gold, you sell some gold, right? And then buy something you're low on. Does that make sense? Now, if you have not enough stocks, you need to buy more stocks. So maybe gold is high, so you sell off some gold and then you buy stocks. All right, depends on what's high, what's low. Sell the high ones, buy the low ones. It's a way of locking in your gains over time, and that's what makes a portfolio work, is the rebalancing portion. Okay, so that's how to theoretically do it. I'm going to give you 3 examples today. All right, so let's begin. 3 examples of how to rebalance. So I actually was working on my mastermind group this morning. And if you want to join a mastermind, by the way, go to yesfinanciallyfree.com, go to the products page, click on the Finance Freedom Mastermind product, and then select that, and then go through it and follow the instructions, and you can join a mastermind if you want. They're very powerful groups. I highly recommend it if you want to become financially free. Okay, so I have a real life example. I did my son's rebalancing today. So I'm going to write down, he had $75.84 in gold, It's very similar to the numbers, $75.48 in commodities. Okay. And he also had $389.50 in long-term U.S. Treasuries. And he had $167 in intermediate. Okay, U.S. Treasuries. And then he also had $324.64 stocks. And he had $154 cash. Now, the reason he has cash is because we put money in his account every month. Last month, we put in $121 cash. So he's got cash in there growing every month. Now, I don't always invest it every month because sometimes I invest every other month. But basically, for him and his portfolio, okay, we are investing, we're putting money in once a month, okay? And his total, the total to invest is $1,186.46. That's the total. Okay. Now, this is not the amount of money that we invested. This is the amount of money that it's worth, okay? This is the amount that his different securities are worth at this time today. Now, he's actually gained money, right? Since we started, he's gained $98 in value over all the categories, different ways, but he's gained $98. We started in October. We've been putting in money like $100 a month, and we changed $10 a month and so on. So graduate. So that's called we're basically doing dollar cost averaging, but basically we're just putting in money once a month. This is the typical way most average people would put money into investment account. They would pull it out once a month. Now, some people do once a year. Sure, it's your choice. But I'm doing the typical example of a mother and a father who put aside money for their children's college education. That's right. He's 6 years old, and we've saved $1,186.46. Some of you might be thinking, you're so behind, but this is where we're at right now. Okay. So today, I rebalanced his portfolio. So how did I do it? So these are the numbers. The first thing you have to do is you have to figure out what they're supposed to be according to the percent, okay? So I figured out, okay, this is supposed to be 7.5%. Long-term treasuries are 40%. Intermediate is 15%. Stocks are 30%. And cash, you're not supposed to have cash. So basically, the total is here. You take this total and you figure out what are those percentages of this total. And that's how much you should have in every category. Now, I don't have that, right? So that's the point. So let's begin. So what you do, and if you guys are really smart, you can use a spreadsheet or something. But anyway, basically, I went through and I said, okay, so what should it be? So I calculated the percents. 7.5% is 88.98. Okay. So that's 7.5% of $1,186.46, which is the total to invest. Okay. That's what he has, market value, and all that stuff. So let's see. I'm going to go in the percent basis that I put on my list. It's not exactly in any great order, but we're going to do it that way. Okay. So 474.58. Okay, and then we have 30%. 30% is 177. Oh, sorry, that's 15. So I did the math already, so I'm just writing it out. $167 dollars, and then that's 15%, and the last one is 30%. 30% of $1,186.46 is $355.94. And remember, this is all from the total that we have to invest or have invested. Okay. So I took this number, 1,000. So I figured out how much is in the investment portfolio. So I added up everything that's there now, what it's worth, the current market value as of today. Okay, added it all up, got this total along with any cash I can invest, added it all up. This is the total I got, $1,186.46. Now, I then figured out what is 7.5%, and I did it twice. You don't have to do that, but whatever. Gold, commodities, long-term U.S. Treasuries, intermediate U.S. Treasuries, and stocks, okay? So I found out that 7.5% is $88.98, okay? Now let's look at both our lists together so you can get an idea of where I'm going with this. So basically you take a look at where you're at and where you should be, basically. Okay, so this is where we're at right now. We are at $75.84 gold, but according to this, we should have $88.98. You see that? So the gold and commodities really should have $13 more each. All right. Now the long-term U.S. Treasuries is $389.50 is what we actually have. Now it should be $474.58. So that's off by quite a bit, right? So $389.50 and $474, that's a difference of what? What is that a difference of? Like basically it's almost like $390. So yeah, 10 blah blah blah. So it's a difference of like $85, right? $85 difference. So we definitely can buy more long-term US Treasury, $84 worth, right? And then 15% should be 167. And what we have actually is, wait, really? It was 167? Really? Are you serious? Did I write the wrong number? I wrote the wrong number. That's why. Ha ha ha. I wrote the wrong number. I'm like, it cannot be identical. That doesn't make any sense at all. Does it make any sense at all? Okay, so I wrote my numbers wrong. Sorry, guys. Okay, so it should be, feel free to correct my math. 15% of this is $177.97. Okay, so it's off by $10. Okay, so it's actually $167, but it should be $177.97. Off by $10, guys. Okay, and the last one is stocks. Okay, stocks are, the value stocks is $154 in my son's account. Wait. Why? Oh my goodness. I'm writing it all wrong. Where did I get that number? Oh no, that's cash. Sorry. Oh my goodness. Okay, it's $324.64 is the stocks, okay? $324.64 is stocks, and it should be $355.94. So it's actually off by about $25, right? $30, almost $30. No, $30, $31, something like that. About $30 off. Am I right? Stocks are $354. Stocks are $324, and they should be $355. Yeah, so it's off by like almost $30. Okay. All right, so you kind of get an idea. All right, so how do you rebalance? Now, the way my son has it, like I said, he's got cash. So the way to rebalance when you have cash coming in every month, the easiest way is to just buy more of the ones that you're low on. Okay, so you don't have to sell. So just buy more. So when I did it this morning, I bought more long-term US Treasuries. I think they were $44, something like that. So it was like, okay, $44. So he needs 80. Didn't I say like 80 something? 10 plus that. 85. He needed $85 more. So let's say US Treasuries were $44 or 40, whatever. So let's say they're $44. So it's close enough. So I would just buy two, right? And then basically increase his long-term treasuries by $88. Okay. And then you get much closer to what it's supposed to be. All right. You understand? Okay. Now the gold and commodities, I looked at gold's price, looked at commodities price today. And like I said, it's off by $13. Okay. So gold is 7.5%, commodities 7.5%. Okay. So gold and commodities, the funds that I have for my son, gold was like you had to pay $18. So I just bought one more gold, even though it's $5 more. Commodities, you needed $25, so I just left it. I just didn't buy more commodities this time. Maybe next month I'll buy one more share of commodities. Commodities was a little high, okay? So that's what I did there to rebalance. And then for in the intermediate, it was only off by like $10, and the share price was $33, I think, for intermediate U.S. Treasuries. So I did not buy, and I will buy next month probably, or the month after. And the last one was stocks. Now, stocks was off by like $25, and I think a share of the stock fund was about $33 or so. So I bought something like that, $30 around there. So I bought a share. So it was over the 30%, but close enough. So that's how you rebalance. Okay, guys? So you take a look, you figure out what you have, figure out what it's supposed to be, okay, what you have, what it's supposed to be, and then you figure out what's the difference, and then you use your cash, and you just buy until you get close to what you should be at, okay? So buy shares until you get close to where you should be, and then you just do that every month or every other month as you put money in the account, okay? So that is a real example of my son's portfolio. Now I'm going to give you 3 examples. So let's do another one. So this next example we're going to go through is another one. Now this one of my mastermind members invested money. And I'm just going to write down everything again. So gold, 7.5% is what it should be, and they were at 10.59%. Commodities are also 7.5%, and they had 8.09%. And then they had long-term, U.S. bonds were 35. It's supposed to be 40%, and they had 35%. Okay, so he did like a percentage basis. So I'll just show you. He did like a current percent basis thing. 15%, and then he had 14.02%. And then stocks, he had, it should be 30%, and he had 31.84%. Okay, so this is another one. One of my mastermind members invested some cash, and he did a one-time investment. So some people can do what I did. So with my son, I did $100 a month for a while. Then I started adding more. With him, he took a larger chunk of money and he just threw it in. Okay. So like $5,000, and just invested it according to the percentage. Gold 7.5%, commodity 7.5%, long-term U.S. Treasuries 40%, intermediate U.S. Treasuries 15%, stocks 30%. So he just took $5,000 and divvied it up. Now today, he checked it. He wanted to see how's the balance. So he just did, what he did was he figured out the percentages. Okay, so how much do I have in gold? How much do I have, blah, 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 blah. What percentage is that? And he wrote down the percentages. Now, he's doing a quick check. He does this. He threw a chunk in. He's not adding money every month. So it's a different kind of investing, okay? Now, he notices gold is 10.59%. That's higher than 7.5, right, guys? Now, commodities is pretty close. 8.09, 7.5, that's pretty close, right? US Treasuries, 40%, 35%. That's off by 5%. And then intermediate's pretty close. Yeah, 14, 15. That's really close. Stocks are also really close, 31. So if he wanted to rebalance now, and he doesn't have to because he started it in like March, and they recommend Ray Dalio and the book Money Master the Game by Tony Robbins. They say to invest, rebalance at least once a year. You can do it more often. So if he wanted to rebalance now, since he just put a lump sum in, what he would do to rebalance is he would probably sell gold, right? Sell some gold to get it down to the 7.5%, and then buy some long-term US Treasuries to get it up to 40%. Okay, so that's how he would probably rebalance. So sell the gold until you get to 7.5%, right? Or close, and then buy long-term US Treasuries. Everything else is really close. Yeah, commodities are pretty close. So that's how he would rebalance. Okay, so that's the second example. And that's if you have a lump sum. Okay, so the first was dollar cost averaging, second is a lump sum. Okay, and I have one more example. And this is a good example too, because this one is someone just beginning and they just started and they're only investing like a couple $100. So let's begin. So the same thing, we have gold. Gold should be, so we have gold. I'll just put in what it's worth. So it is 7.91. They have commodities. Commodities is $39.20. Long-term US Treasuries is $169.32. Okay, intermediate term US, they don't have anything, okay? They have 0. And then because they didn't have enough money to buy that one, the price per share was higher. Okay, and then stocks, they have $324.64. Oh, sorry, getting confused. Writing the wrong numbers. 169. Okay, got that one. Okay, 156.72. Okay, and they do have cash as well. Cash 126.33. Okay, so this is the second example, third example. Now they have money invested in gold and commodities at 7.5%, remember? And if you just a refresher, 7.5% is gold, 7.5% commodities, 15% US intermediate term treasuries, 30% stocks, 40% long-term US Treasuries. Okay, so that's the percent. So this is their dollar value that they have in their account: $37.91, $39.50, $169.32, and stocks are $156.72, and they have $126.33 cash. Okay, so the total is $529.48. Total. So the total in the account is $521.98. So 529.48. So they have to figure out, according to the percentages, what is 7.5% of that? And then that would be your gold and commodities. What is 40%? And that would be this number. Okay. What is 15%? That's US, that's intermediate US Treasuries. And then stocks is 30%. All right. Now, I actually don't have a calculator. Wait, maybe I do. Let me get a calculator, because then we can do it together. So you can kind of get an idea of the math. So this is a longer video, but I want you guys to be able to understand how this goes. Now, in the blog post, I'm writing this all out, but in case you wanted someone to show you, I'm doing a video tutorial as well. So let me see if my husband's iPad has a calculator on it. I'm pretty sure it probably does, but let's find it. Calculator. I don't see a calculator. Calculator. Wait, maybe it's in here. That is so funny. Maybe he does not have a calculator. I guess it happens, guys. Thought all these iPhones and iPads had calculators. Oh well, he doesn't have a calculator. Okay, so I don't have a calculator right here, but you would probably need a calculator. You can do it by hand if you really want to. Let me see if I have a calculator nearby. I had one somewhere. Ah, calculator. Ta-da. Okay. Okay, so 500, remember our total is $529.48. Okay? So 529.48. 529.48, and then you want to know times 0.075, because that's 7.5% is 0.075, and then you equal. So funny, this calculator is not the best calculator. I apologize for that. So anyway, if you guys are watching live, you can calculate it on your own. Figure out what the percent would be. I need a better calculator. That's just wrong. I wonder if I have another calculator. I don't know. Yeah, because I'm doing a live on Facebook. That's why. So I don't have a calculator. But basically, you'd figure out what the percents are. I'm going to get one more whiteboard. Okay, guys. So basically, 520 is almost 530. So I'm just going to put 530. All right. So we need 7.5% of 530. So you take 530 and multiply by 0.075. I'm totally old schooling it. That's what I'm doing. I know. I'm old schooling it. Okay, let's see if I get the right number. Oh my God. Okay. All right. So 5 times 0, good job, 15, da-da-da-da-da. Okay, and then 7 times 0, okay. Okay, I think I got it right. All right. Move it over 3 space. Okay, I did it right. $39. So it should be $39. These two should be $39.75. All right, so gold and commodities should be $39.75. Now they are close. All right, so she doesn't really have to do anything with that. All right. We're doing good here. We're good with math, okay? Oh, old school it, Old school it. Okay, 40% of $529.48. Now I'm doing it, as you can see, I'm calculating this and I'm actually doing this. And I did this. I rebalanced my son's portfolio. Today I'm going to do my husband's after this live video when I'm done with my blog today. So this is something that I actually am doing, okay? So let's see. Oh, math. Let's do this. I can do this. I'm a math wizard. I remember my multiplication tables. I do. Yes, I do. 121. Whoa. 3 decimal places. 211. So $211.75, 40%. Now, I hope my math is correct, okay? But I got 211. And it looks like for long term, she has 169.32. But I think I did it right, okay? 4 times 8 is 32. I'm pretty sure, right? Right? 286, yes, that's totally 32. 12, 15, 1, so 32, 36, 37, 3, carry is 8, that's 11, 1. Yeah, I totally did my math right. 211.75. So should have 211.75, okay? So 40% of this number on the bottom, this big number on the bottom, the total. Whoa, sorry. Okay, 40% is 211.75. 7.5% is 39.75. Good, guys? We're doing good. Okay. So now we take the same number, the total, because we're picking out percents, right? And we're going to do 15%. because that's the next one, her long-term. And she doesn't have any intermediate term U.S. Treasuries is 15%. She doesn't have any because she couldn't afford it when she first started because it was the shares were too expensive. She didn't have enough cash to buy it. So she just left it empty. Okay, so got 40, 24, 2, 45, 47, 4. This is good math practice. I should practice my multiplication tables with my son, and then I will get better at them. Especially now that they're all homeschooling and not sending kids to school anymore. Probably will be practicing multiplication tables with him and getting all good at it again. All right. Good. I didn't forget all of my multiplication tables. I'm proud of myself. Good job. Good job, Melisa. Good job, May. Okay, and I need 4 decimal places. So 15% is $79. $79.42. Okay, so I just did the math. 0.15 times 529.48, and I got $79. $79.42. All right. Now, another thing, when you do your math, whether you do it like me, manually, or you have a calculator like a normal person, always eyeball your numbers and make sure they look right, because 7.5% is half of 15%. So this should be double, and $39 double is about 79. I don't know, 39 is almost 40. Yeah. See, so you know you're right. Okay, so eyeball your math, okay? All right. Last math problem, 30%, doing stocks, okay? So 529.48 times 0.3. Okay, 3 times 24. 3 times 8 is 24, right, guys? Oh my God. Okay, doing awesome. Whew. Love this. 6, 7, 8. Anyway, you can always check my math, but 3 times. Okay, so this is 30%. 30% is 158. 158.84. Okay, 158.84. So back to old school math, guys. And if you don't think I believe that is hard, trust me, look at me just suffer right there. But I did it. I did my math. Okay. So now you know, right? 30% is 0.3, right? You do your multiplication tables, figure it out. All right. So this is her. All right. Her gold and her commodities are $37, $39. It should be $39. She's good. She's pretty close. Long-term U.S. Treasuries are $169, should be $211. So she could buy more long-term U.S. Treasuries, okay? Intermediate U.S. Treasuries, she has nothing, okay? Now, she needs $79.42. Since she does have cash here, she could buy intermediate U.S. Treasuries. Now, I think the reason she didn't is because one share of it was over $100 for one share. So I think she's just waiting to build up her cash. And you can do that too. So if you have only this much in your portfolio and one share is like $120 or something, I think it's like $120. I don't remember, something like that. One share of this is $120 something. Now her proportion is $79 right now, but the shares are too expensive. So she's just waiting. And she puts money in every month. So when she finally gets to the point where 15% of this is like around 120 or whatever the price of this share is, she'll buy one share. Okay, so just to understand, if you're starting out with not a lot of cash, you don't have to put money in each one right away. Just keep adding the cash in once a month or whenever you do it. And then as it gets higher, you just redo your calculations and see if you can get each category in balance. Okay, so right now she's not in balance for this because she can't afford the share. Stocks are 156.72 and should be 158.84. So she can also, this is pretty close, so she doesn't have to do anything. So really, she has two things she could do. She could buy more long-term U.S. Treasuries because she wants 211. Now, I think the reason she hasn't is because these two are both over $100 per share. And so she's just waiting for her cash to build up. Okay. So if you only need like this one, $79, but it's $120, you got to wait, right? Because you don't have enough cash. It's not, the proportion's too low. And then this one, 211, 169, you're off by about $42 or so. If the shares are over $100, you just have to wait. Okay, so these are examples of how to rebalance. Real life, 3 examples I went through. This is one where you're just starting out, you just put in some money, you just started buying, you can't afford all the shares yet. What can you do? This is how you rebalance. Okay, so what she'll do is she'll keep adding money and then she'll do the same percentage work again. Maybe in 6 months, maybe in a month, depends how much she puts in. Okay. So that was 3 examples of how to rebalance an all seasons portfolio. My name is May Dool-Delau. My blog is yesfinanciallyfree.com. I hope you got a lot of great value out of today's live video. I did the math manually, so you should know how to do it now, hopefully, but you can always use a calculator, like I said. If you want to use a calculator to figure out percentages, it's probably easier. I usually use a calculator. But I can still do math by head. So the blog is yesfinanciallyfree.com. I will write out all the examples and explain them so that you don't have to watch the video if you want to just skip through to figure out how to do it, if you want to do that. The video is here for people who want a verbal explanation. So I'm glad you're here. Good luck with your portfolio. If you're using all ceilings, good luck. So far for us, we've really liked it. But, and it's recommended by Ray Dalio, Ray Dalio is a very smart man. He's you can Google him if you like. And he was interviewed by Tony Robbins for the book Money Master the Game. So he is the one who recommended it, and it was tested by Tony Robbins, their group, to see how it did, and it averaged 9.72% for the average annual percentage yield over the last 30, 40, 50 years or whatever. They did a really long. Went back a long time to see. So it's a pretty stable, nice portfolio to try. And if you're doing it by yourself, these were 3 examples to help you do it by yourself. So have a great day. Subscribe to the email list. And if you want to join the mastermind program, you're more than welcome to go to yesfinanciallyfree.com, go to the products page, and click on the mastermind button. Have a great day. Aloha. Bye. See you next time.